To kick things off, we thought it would be really interesting to level set a little bit, and this is a little bit less fun of a statistic, but I think it's an important one. When we look at sort of what returns might be available in public markets, so just public stocks and bonds over the next 10 years, that's a group that's delivered amazing returns in the last 10 years. But if you do some very simple back-of-the-envelope math, what you get is a kind of depressing number of something between 3 and 4% nominal returns. Take whatever inflation is out of those over the next 10 years. That's pretty lousy. And that highlights, I think, why it's so important to be constantly searching, no matter who we are, for interesting ideas sort of at the edge or the frontier of the various asset classes. Now, with that in mind, we thought it'd be fun to start with a presenter who I would call a professional mythbuster, among other things. His name is Dan Rasmussen. Dan started his career in private equity before starting his own firm called Verdad, where he applies most of what he found was the actual most effective parts of private equity to buying public securities. Dan and his team do a lot of quantitative research, and again, in the spirit of not wanting to just regurgitate that research directly to you because some people have seen it, what we asked him to do was a talk called the Five Heresies. So Dan is going to basically line them up and shoot them down, going through the major asset classes, things like private equity, venture capital, credit, corporate leadership, things like this, and hopefully make us all aware that while these asset classes can deliver great returns, they are not preordained returns. So please join me in welcoming to the stage Dan Rasmussen.
Thank you, Patrick, for that introduction. Hopefully I'll live up to it and make some interesting remarks today. And I promise that it'll be an uphill. Every speaker after me will get better and better, so there's a lot to look forward to. Starting with a low bar, I guess. Investing is a game of meta-analysis, not a game of analysis. What matters is not what you think, what your analysts think, what your Excel models think, but what you think relative to what everyone else thinks. There are therefore two broad successful strategies for winning in investing. The first is to relentlessly stay on trend, staying just ahead of the herd, buying the sexiest, most in vogue assets at a given moment. Quants call this momentum. The second is to identify the places where the consensus is wrong and to take the other end of the bet, to be a contrarian. Quants call this value. Contrarian value investors ask the same question that Peter Thiel asks everyone who interviews at his firm. What's one thing that you believe that the vast majority of your peers disagree with? I want to provide a few answers to Peter Thiel's question. To start with a few blasphemies, heresies, and challenges to conventional wisdom. I have two goals in doing this. My first goal is that you disagree with at least some of my ideas. Ideally, the majority of you disagree with the majority of my ideas. If not, I have done a poor job of introspection and evaluating how controversial my ideas really are. So hopefully I achieve that. Maybe I'll even enrage some of you, which would be a really mark of success for my talk. And my second goal is to back up that controversy with data and with rigorous quantitative analysis, such that there is at least some evidence I'm proffering for why my point of view is right and yours is wrong. I plan to start with three challenges to limited partners, talking about asset allocation, and specifically about the risks of the new institutional love affair with illiquid private alternatives. I then want to challenge the GPs on how they make decisions, and specifically the consensus around business quality and management quality, and how much that matters to returns. Let's dive in. The endowment model of investing is today the ultimate consensus smart money trade. Endowed institutions have adopted in widespread adoption of the model pioneered by David Swensen at Yale, or perhaps duplication of David Swensen's ideas. Now, broadly, what is the endowment model? What are endowed institutions doing with their portfolios? The very big shift is a shift out of fixed income into illiquid alternatives. So in the 1990s, the average institution had about 55% of their money in equities. Today, the average institution has about 55% of their money in long-only equities. In 1990, the average institution had about 35% of their portfolio in fixed income. Today, that's about 15%, and now they have 25% in alternatives. I call this the flight from safety. I think it's gone too far. And I think that endowed institutions are putting themselves in a far riskier situation than they truly understand. And I want to talk about why these illiquid private alternatives are not all they're cracked up to be, and why investors should be reducing, not increasing, their exposure to private real estate, private venture capital, and private equity. In the discussion of private equity, I'll also touch on private credit to some extent as well. So first, real estate. Real estate, I wanted to start with real estate because real estate is very simple, right? At the end of the day, it's buildings. And you can fix up the buildings, you can re-tenant the buildings, but you can't really do all that much more to the buildings. Although maybe with WeWork, you can community adjust the EBITDA, so it's even more exciting. But broadly, real estate is real estate. And thus, real estate provides a very good testing case for some of the worst justifications for buying private illiquid assets. The first of those is the idea of an illiquidity premium, right? That you should pay 2 and 20 to have your money locked up for 10 to 12 years in something illiquid, and that's somehow better than paying 50 to 90 bips to have it in a public liquid vehicle. Over the past 25 years, real estate private equity has lagged public REITs by 3% per year. That's 7% per year versus 10% a year for public REITs. Over the past 10 years, that lead has been extended to 4%, so the average real estate private equity firm has returned 6% per year. The average public REIT has returned 10% per year. REITs have outperformed private real estate in 69% of rolling 5-year periods and 80% of rolling 10-year periods since 1982. That's true across major property types. So the quick counter argument, people say, yes, that's true for core real estate, of course, but not value added or opportunistic. But unfortunately, it's true for both of those as well. And one of the big reasons for this is fees. So private equity funds charge the notorious 2 and 20. Now, obviously, that's coming down. But the average public REIT only charges 89 basis points to manage your real estate portfolio. And so you can actually attribute much of that 3 to 4% gap between public REIT returns and private real estate returns to simply paying significantly higher fees. So we see here that if your argument for moving into illiquid assets is based on the idea of an illiquidity premium, the most obvious rebuttal is, hey, look at real estate. There is no illiquidity premium. In fact, there is a 3 to 4% illiquidity penalty that you pay to own these assets in a high-fee private illiquid asset. Right? So I think that as a starting point, we can debunk the first and most obvious argument about private illiquid investments, that somehow they are just naturally better in some way than owning things in the public markets where things are so volatile. So let's move on to venture capital. And I know there are a lot of venture capitalists here today, so I hope to grievously offend all of you. We all hear stories about successful venture exits, how the early investors in Uber or Beyond Meat made 100x returns on some tiny amount of money. I put in 50,000, then I walked away with 20 million or something like that. We hear less about the 65% of venture investments that lose money, which is a worse base rate than almost any other major asset class. Actually, CCC bonds, so distressed bonds, defaulted a rate of 30%. So you're talking about like a default rate double that of CCC bonds. So most venture investments are terrible. Interestingly, a mere 29 venture funds explain 51% of the profits in venture capital. So the average experience of an investor in venture is actually significantly worse than the aggregate indices. And what's even more frightening is that just like in real estate, venture has significantly lagged the public market equivalent. So over the past decade, the NASDAQ returned 14% per year. The Cambridge Associates Venture Capital Index returned 10% per year. Venture also lagged the Russell 2 and the S&P 500 over this period. In fact, the only consistent multi-year period in which venture has beaten the public markets is during the tech bubble in the late 90s, when venture capital returned 70% per year over 6 years. I think that was 93 to 99, so that was pretty great. And then it returned negative 34% per year for the following 3 years, so up and then down. It's like Bitcoin or something. Maybe it's exactly like Bitcoin. They're both bubbles. I'm probably going to offend the crypto people here too. But I think venture is, in some sense, quants divide the world into these style buckets, right? The Fama French style buckets. There's large growth, large value, small growth, small value. And then for the sort of Goldilocks types, there's mid-cap value and mid-cap growth. And then there's like the middle of the middle and the middle of the small. And, I don't know why we divide it into all those categories. But in any case, the very best performing asset class is small value over long periods of time. The very worst performing is small growth. Largely because, as we talked about investing being a game of meta-analysis, right? In small growth stocks, people are always hoping and expecting great things, and they are inevitably disappointed some large percentage of the time, which is why small growth has performed so horribly. And venture is small growth on steroids, right? You're not just choosing, the public equities are much bigger, generally a much higher percentage of them are profitable or even cash flow positive, whereas the venture investments are smaller, more illiquid, often, lower in profits, burning more cash. And so it's an extreme form of small growth, which is the worst returning asset class. And so in some sense, I call venture the rich man's lottery, where a few profit, but the vast majority lose money. They have high expectations, they imagine those lottery-like outcomes, but the vast majority of people are disappointed as the vast majority of venture capital-backed companies go bankrupt and disappear at astonishingly high rates. Even more frustrating, we talked about one of the key ways to win in investing being to stay relentlessly on trend, to keep buying the most in vogue, sexy assets just ahead of the curve. Well, why would you lock up your money in something illiquid if you know that the trend is going to change 3 years from now? And okay, Groupon is now out, and crypto's in, and now crypto's out, and fake meat's in. Well, what's going to be in next year? And trying to stay on top of this is actually much easier in public markets than it is in private equity or venture capital. On to my next. Patrick promised that I had to sort of raise these topics and then knock them down and move quickly. So I'm trying to keep a steady pace here. So private equity, which is of course my favorite topic, my bête noire. 94% of institutional investors believe that private equity will beat public markets over the next decade. 94% of institutional investors, right? A remarkable consensus. And as a result of this, about 3 to 4x the amount of money is being raised by private equity funds today than that was raised 10 years ago. And it is the ultimate, this is the crown jewel of illiquids, right? This is what every endowment is trying to build. Cambridge Associates recently put out a paper saying that you should have 40%, families should have 40% of their assets in private equity, that institutions should have at least 15, right? And so this massive allocation into private equity. Why is private equity supposed to be so great? The first reason and the most popular argument I get is about past performance. So from 1990 to 2010, private equity returned 14% per year, compared to about 8% per year for the S&P 500. So about 6% outperformance, and that's net of 220 fees. So the actual gross returns of private equity probably looks something like 20% per year over that 30-year period, right? So I think we can concede that for about a 30-year period, 25-year period, private equity was actually a great place to park your money. And interestingly, as we talked about, the best performing asset class over the long term is small value. Small value had pretty similar returns to private equity over that period, but on a net basis, right? On a gross basis, private equity beat them, and that's really because private equity firms were using leverage. So the average private equity deal is leveraged 65%, the average public equity is levered 10%. Well, if you take something good and then you lever it up, it turns out it's even better. And that is broadly was the story of private equity for 25 years. Now, every institution caught on to this, and they caught on to it at about the same time that passive index, the data around how often passive beat active was catching on, and how difficult it was for Morningstar and others to pick funds, right? It's really difficult to pick public equity funds. And so a lot of the institutional investment consultants said, well, gee, what we really need to do is build out our privates business, right? Because privates seem to be winning, they're high fee, it's hard to judge their performance, so they can't criticize us if, to be 10 years until they know if we put them in the wrong fund, so gee, this is great. And started to go around to every single institution in the country and saying, okay, 15%, now 15% is too low, 40%, right? Put it all into private equity. And there became a sort of series of half-baked justifications. First, the illiquidity premium, right? It's very, very good, except it doesn't exist. It doesn't exist in real estate, doesn't exist in venture, maybe it exists in private equity, but it doesn't seem to. The next was that, all these private equities they got, the guys that they meet, so nice, so smart, so tall, so handsome, so good at running companies, and then they really care about the companies they own. It's not like those public guys, they go in, they go out, it's a trade. They don't own the company forever, right? Like the private equity guys. And now the private equity guys, they're delivering that even more, because pre-2006 hold periods were 3 years. Now hold periods are 6 years. And they've pitched that they're thinking longer term now, right? I mean, it's not that they can't sell it, right? It's not that they can't sell it. No. It's that they have a vision, right? I mean, it takes years to execute that type of strategic change, That's why they're waiting to sell, right? You just wait until you see the outcomes. But the frightening thing is that even though the majority of private equity investments are that have been made over the past 10 years are still in private equity portfolios, so the majority of private equity performance is based on what the private equity firm's accountants think those companies are worth, which is a wonderful arrangement, by the way. I've been meaning to ask the SEC if my mother could value my portfolio every quarter. I don't think they're going to be too hot on it, but it's not dissimilar from the way private equity firms mark their portfolios. But remarkably, even given that they make up their own valuations for the majority of the things that they own, over the past decade, private equity's public market equivalent returns versus the S&P and the Russell 2000 is less than 1. So in other words, even with making up their own marks, private equity has failed to outperform the market. Why is that the case? Now, it's still equal to, so it's not dramatically worse like venture or private real estate, but it's equal. And I think it's going to get worse. And I want to explain just very briefly why this is happening and why private equity today is so scary. So as we talked about, private equity is levered small value, or at least was historically. About 65% net debt to enterprise value is the long-term average. Now, what's happened is as the money is flooded in, there's a limited number of public companies that go up for sale. And so as money has tripled or quadrupled into private equity, right, there's a frenzied bid for every one of these private assets that's of any size. So the minute you hit 20 million of EBITDA or 25 million of EBITDA, there'll be 50 private equity firms submitting LOIs to the auction. And that means purchase prices have gone up. Now, the purchase price data is a little tricky because the private equity firms report pro forma EBITDA. And most estimates say pro forma is somewhere between 15 to 30% higher than GAAP EBITDA. But on pro forma basis, the average private equity deal in 2018 was done at 11 times EBITDA with 6 times net debt to EBITDA. Now, that's not that scary in a public market context. Okay, 11 times EBITDA, roughly average for the S&P 500. Okay, so it's not really that scary. The scary number is 6 times net debt to EBITDA. And this is something that people don't understand about private equity. Basically every LBO transaction is a leverage buyout. They're putting this amount of debt on these deals. And 6 times net debt to EBITDA is a truly frightening amount of debt. That's a triple C, at origination, that's a triple C credit. And triple C credits default at 30%. A 30% rate over a full cycle. So for some reason, today, I think a lot of people think that maybe we're late in the cycle, maybe this is high valuations. People think that the very best idea that they have is to lock up their capital for 10 to 12 years in illiquid, microcap, highly levered equities that are subordinated to triple C debt. Now, to me, that seems like the craziest, like most high-risk investment you could possibly make, and in sort of the order of magnitude of stupid things you could do with your money, pretty far out there. And yet, this is something that 94% of institutional investors agree on. It boggles my mind, and we can talk more about that. So now, even more frightening about all these illiquid private assets is that these are not actually substitutes for the way that I just presented it, right? Okay, public equity versus private equity, the NASDAQ versus venture, public REITs versus private REITs is not actually how most institutions have actually acted. In fact, what they've done is shifted money from fixed income into venture, from fixed income into private real estate, and from fixed income into private equity. And they've done this because these private assets are all marked with lower volatility than fixed income, right? So because it's quarterly marks, because it's the accountants, the reported volatility of these private asset classes is actually lower than corporate fixed income. And so they can basically shift their fixed income portfolios into equity risk, levered equity risk, at fixed income level volatilities, right? So what's truly frightening is that these endowed institutions, right, the genius of their model has been to shift fixed income risk, right, into levered equity risk, and to do so probably at one of the worst times, and with the justification that this return smoothing makes it not actually that risky, right? That this is actually an effective substitute. And I think hiding risk from yourself, from your committee, is not a genius idea. It's actually a very dangerous idea that prevents you from getting feedback. And so I hope that for those LPs that are listening to this talk, you will think about your own portfolios. Have you been substituting fixed income for illiquid privates? Are those illiquid privates taking on too much leverage? And do they justify, right, are they beating the public market alternative? Are you getting the premium for illiquidity that you should deserve for locking up your capital and paying 2 and 20? Now, shift very briefly to talking about two topics that are relevant to GPs. There are two, I think, broad themes that investors like to talk about. The first is the quality of the business, the wideness of the moat. This is classic Warren Buffett. And the second is the quality of the management team, right? The idea is that you want to back great businesses run by great people. So one of the things that we did just for fun was to disassemble a database of 8,500 CEOs of public companies and look at a few different things. One, we said, did they have an MBA or not? Two, did they work at an investment bank or an elite consulting firm? And then three, if they'd had a tenure longer than 6 years, how do the first 3 years compare to the next 3 years, right? So is there any predictive power to having a great pedigree or having a great track record? We even looked at people that were CEO of one company and got hired to run another company. We found that for all of those tests, there was no statistical significance to any of them. In fact, pedigree, past performance, even past performance at another company was not predictive of future success. In other words, there was no way to judge who was a good CEO or a bad CEO in advance, and all the standard headhunter characteristics didn't predict much of anything. And in fact, even more striking, another report found that despite very wide acceptance of the idea of aligned incentive and executive pay for performance, there's no evidence that total incentive comp results in higher than average shareholder returns either. So we're paying CEOs more and more, we're aligning their incentives with the equity, even though the CEOs seem to have largely no role in this, at least that's predictive in advance. The idea is that essentially that if management, if we can't predict who's a good manager, why should we pay them so much? Why should we think their pay needs to be aligned with their stock price performance? The next idea, very quickly, and then I'm going to go to questions, is the idea of Porter's competitive advantage, Michael Porter's competitive advantage, the 5 forces that make for a great company. Interestingly, all of these 5 forces relate to market share, right? If you have more market share, you have more power, more force over your suppliers, your competitors, your customers, right? If you have 100% market share, if you have a monopoly, presumably that's the best, and you can have the highest margins. This is the idea behind competitive strategy, behind moats, and it's an idea that suggests that the bigger you are and the more of a market you control, the better your outcomes are going to be in terms of your margins and your stock price performance. Unfortunately, there is no evidence, no single empirical study that supports these conclusions. And in fact, in 3 different fields, the Supreme Court ruled that this theory was unacceptable in arguments about antitrust law, that there was simply no evidence that higher market share resulted in higher margins, so it was forbidden in 1981 from the courts. Second, this was disproven actually within the field of business studies, of the study of how industries work. They basically found that industries are so heterogeneous that none of the market share variables have any predictive power. And then third, when you look at stock price performance, there's no relationship between market share and stock price performance. In fact, an Oxford professor said there appears to be no falsifiable, unfalsified theory of competitive advantage, nor any competitive advantage propositions defensible without resort to ideology, dogmatism, or faith. And I think that ideology, dogmatism, and faith are poor foundations for an investment strategy. So I hope today that I've taken 5 dogmatic, ideological, and faith-based points of reasoning around illiquid private investments, great companies, and great CEOs, and exposed them to some level of empirical skepticism. And I hope that this talk will make you question what big ideas in investing that you encounter or believe to be true, where they are on the dogma, faith, ideology versus empirically supported ideas. Thank you.
Thanks, Dan. You can see why when I first met Dan, one of the things he said, which I thought was hilarious, was that in school, his teachers either loved him or absolutely wanted to kill him. So you get a sense for why that might be true. So we've got time, 8 minutes or so, for a couple questions to double click on some of your ideas. These have all been submitted from the audience. So the first of these questions is, given that everyone is investing in private equity, I doubt that this talk is going to stem that tide. Are there any ways of identifying private equity firms or even companies where the mythical sort of operating improvements might actually be true? So surely within the private equity universe, there is the ability to select better firms, better funds. Anything in the quantitative evidence that suggests what PE firms should be doing, and therefore what LPs should be looking for in the PE firms they're engaging with?
Yeah, so I think what we found, and I'm not against all private equity. I'm against private equity that's done using 5 times, 6 times net debt to enterprise value, and really above 10 times purchase prices. So what we found is that at Bain Capital, when we did a big study into what drove private equity returns, about 60% of the profits came from the 25% of deals done at less than 7 times EBITDA. So I believe that if you can do levered buyouts at less than 7 times EBITDA, you're going to get returns that look like the pre-2006 returns of private equity. And so the first thing you need to focus on, purchase price, is going to be the biggest possible driver. So if you're looking at private equity funds, are they able to buy cheap? Now, the problem today, in addition to the pro forma problem where they all tell you everything's 7, but really on a GAAP basis it's like 12 or 13, the other big problem is that everything goes up for auction. So unless there's some proprietary sourcing mechanism that's allowing you to see deals that others don't, there's no way you can get those purchase prices. And you have to be small. Small private equity firms that are able to buy at low prices with proprietary sourcing, that I broadly believe in. When it comes to operational improvements, it's much harder to prove empirically. The only thing that you can sort of prove empirically from an operational perspective about what private equity firms do is that they add debt. And then within the universe of private equity firms, the only thing that's really identifiable through a quantitative methodology is that some firms are good at cost cutting, but we don't know whether that's sustainable in the long term.
So let's move to public markets where you operate today. And again, with our focus on sort of niche and esoteric, one of the things that you do that's very interesting is a focus in Japan specifically. So Japan is the market that, for any quants in the room, know that it always befuddles quants because it seems to be the exception to every rule. Very interesting country, interesting equity market. So why is Japan appealing, generally speaking?
Well, Japan is extraordinarily cheap, so it's very seductive to value investors, but there are reasons and problems that are unique to Japan. So since the 1990s, they've had zero interest rate policy. This has basically meant that you have no bankruptcies, right? So the banks are willing to sort of extend and pretend. So Japanese banks are kind of scary, right? Because they've got so much kind of zero interest rate debt that's questionable, whether you're ever going to get anything back. And the government will actually step in to further guarantee loans. So you see almost no delistings in Japan. So in the U.S., quants are constantly dealing with delisting problems. You look at Japan; it's the same companies that were there in 1980 or even like 1960. I mean, it's insane. I think the average age of a Japanese public company is like 100 years or something. I mean, it's crazy. And this is because of this no delistings phenomenon. But on the flip side of that, right, you might say, oh, that's really good, right? Nothing ever goes to zero. That's wonderful. But one problem with that is that the Japanese CEOs are extremely oriented about making sure their companies last another 100 years, right? So they're very, very risk averse. They like to hoard cash. They will do things that are in the benefit of their employees and not for their shareholders very reliably because they've guaranteed lifetime employment, and that's very important. So our view is that an effective strategy for investing in Japan needs to take into account these institutional incentives and cultural incentives. Now, activists think, okay, well, we're going to go over there, we're going to fly over there from New York, and we're going to change their minds. I am skeptical of that. My view of it is why not invest in the levered ones where you get the benefits of not going bankrupt, and they want to hoard cash, but in order to hoard cash, they have to pay off the debt first. So, at least there'll be some return to shareholders and some money flowing out, not just sort of an endless cash hoard being built up. But that's why it's of a special interest. My strategy is investing in levered companies. Japan is sort of particularly interesting in light of that.
So the last question that we have time for is a question on value investing, generally speaking. So this has been one of the major trends kind of across all styles of investing that value has been awful relative to growth, really for 10 years now. It's one of the longest periods of terrible underperformance for this style, despite a ton of people that still believe in it. So how do you think about that as a sort of existential concern, that perhaps because so many people now became value investors, kind of starting with the original Graham philosophy, and so much money went into those strategies, that perhaps the prospective returns to value are much lower than the historical ones. And obviously you're focused on value equity. So how do you think about that potential problem?
Well, I think that we have to look at what drove this last 10 years, right? Why did that happen? Why did value underperform? And I think really it's not that value necessarily underperformed, it's that growth really outperformed, right? That's why value looks bad on a relative basis, but on an absolute basis, it looks sort of in line with the long history. And growth outperformed really for a set of particularly interesting circumstances, right? One is that actually US corporate earnings growth are like double long-term averages, right? This has been a really good stretch. And that growth has been concentrated in a set of these large cap tech companies, the Facebook, Amazon, Google, that have just been able to compound year after year very consistent growth rates. And as the factors from Scratch paper that you wonderfully did pointed out, right, for what needs to happen is that the growth needs to disappoint and then the multiple needs to re-rate down. But we've actually seen most of these companies actually beating expectations, right, which is very historically anomalous. So I would say that if you believe that a set of large cap tech growth companies can repeat a historically anomalous, really astonishing performance over the next 10 years, then perhaps growth will win again. But a lot of the winning in growth has been about multiple expansion. So the ratio of valuations to growth to value is the highest it's been other than 99 and 74 at the height of the Nifty 50 boom. So I'd say, obviously there's a chance that value won't work, but I think the odds are in the favor of value investors. And I think probably in the most extreme odds they've been since 99.
Fantastic. Well, thanks so much for all of this. I encourage everybody to find Dan throughout the week. Try to poke holes. He's very open to being wrong, which is a good quality. So thanks again, Dan, for the
Thank you, Patrick.